Citi just out with third quarter results, and want to get straight to Wilfred Frost, who's got the numbers. Wilf.
Hey, Andrew. Yeah, some very similar themes to JPMorgan, in fact. Revenue $17.3 billion, the forecast $17.16, EPS $1.40. The forecast was 93 cents, so a nice beat on both lines. Why the big beat on the EPS line? Because provisions were much lower than expected. That's provisions for bad loans. That came in at $2.3 billion. The forecast, which had a big range, the median was around $4 billion, so lower than expected and much lower than their number last quarter in that area, which was 7.9. So it's gone from 7.9 billion down to 2.3 billion. Though for comparison, JPMorgan's Q2 was 10.5, right down to 611. So Citi had a similar theme, a big improvement on provisions for credit losses, much below last quarter, much below expected, but not quite to the same scale of JPMorgan's. Also wanted to point out that operating expense, 10.9 billion, is elevated. They have booked the full fine that was put on them recently because of that payment to Revlon. Which is booked this quarter, so expenses are higher than expected. Just quickly on the trading revenue, which we didn't really talk about with JPMorgan, a theme here for both of them, which is that we're massively up year over year in trading, both fixed income and equities, but down quarter over quarter, which kind of highlights where we are on that. Q1, Q2, absolute blowouts. We're still ahead of where we were this time last year, but not quite as strong as the second quarter. But their fixed income, commodities and currencies trading was pretty strong, up 18% year over year, down 32% quarter over quarter. So we'll see how that plays out for the likes of Morgan Stanley and Goldman Sachs still to come. Citigroup, I don't know if we've got the share price, see what it's doing in the pre-market, but similar themes there to JPMorgan, improvement on provisions for bad loans, but not quite to the same scale as JPMorgan's. It's up 2%.
That's what I was going to ask you real quick, because I think so many investors are focused on the provisioning issue, not so much as it relates specifically to Citigroup per se, but what it may say about the economy and where we are and maybe where we're going. You're suggesting it's not to the same degree. Why do you think that is?
Because JPMorgan's went from 10.5 billion down to 611, whereas Citi's went from 7.9 billion down to 2.3 billion. But the theme here is key. They're both lower than the essential forecast. The forecasts were unbelievably wide, though, so it's kind of hard to compare it for this particular measure. For Citi's, it ranged from 2.5 to 5 billion. They came in at 2.3. So again, it's something that's pretty hard to put your finger on. And again, this now needs to be paired up with what the management team say on commentary, what they factored in to get to these numbers, and whether they really do see this as turning the corner, that we have bottomed and from here things will improve, or whether this is a one-off quarter, and if we don't get stimulus, then the next quarter is going to see provisions spike again, et cetera, et cetera.
Shepard Smith here. Thanks for watching CNBC on YouTube.